Hi, everyone, and thanks for joining us for this CoinDesk institutional webinar on market surveillance, which on the surface may sound a bit sinister, but as we'll see, it's actually crucial, important for the development of products and liquidity in the crypto market. To look at how it works, how crypto surveillance is different from traditional market surveillance, and what impact it can have on the crypto infrastructure development, I'm joined today by Asaf Meir, the CEO of Solidus Labs, who are providers of crypto-first market surveillance technology. Welcome, Asaf. Thank you for being here.
Happy to be here, Noel. Thank you.
And those of you who've turned into webinars before, well, you know how this works. Asaf and I will chat for about 45 minutes. And again, those of you who've been here before, you know that it flies by. And then we'll have time to get to some of the questions that you have sent in. Thank you very much for that towards the end. Also, again, you probably know this already, but this will be recorded and uploaded onto our website so that you can listen to it again, and also that you can tell your colleagues who weren't able to tune in today. So, with that, let's dive right in. So much to talk about in the crypto market, apart from the price, which we probably won't get to today because, who knows. But let's start with the broad scope. Market surveillance, what does that mean, Asaf?
So market surveillance can mean different things for different people. And I think, as you mentioned earlier, which was really interesting, it has sometimes a sinister, connotation to it.
Especially these days.
Right, I agree. Surveillance is not meant to follow anyone. It's not meant to, understand who's doing what they do sinister, but rather provide transparency into venues and how they're trading, and mainly to detect market manipulation. It can come in different forms. Things that can harm different investors and clients that are trading on exchanges, through broker-dealers, market makers, and other market participants.
How does it do that?
So, interestingly, so this is a fairly, a large question. I think that at Solidus, we're actually using 4 different pillars as we are tackling this problem. The first one is the crypto-native solution, right? Mm-hmm. The idea is that we are able to accommodate for the different data structure and market structure this new economy poses. The other one is that we're using ML techniques, machine learning techniques, in order to understand data anomalies. We're discovering new manipulation typologies that haven't been seen before in the traditional market. Yeah, and which is really interesting. I think that's part of the more interesting part of our job is really to understand new data anomalies, and we don't even have a name necessarily for those new typologies we're finding. Our clients are telling us, we want to find, spoofing of this flavor. And then we're telling them, sure, but you should also look at that type of, portion
like
of
what?
things. Yeah, and we don't even have a name for it yet, but you should definitely look into this. This is unkosher,
And how do you see these things?
So, this takes a long time of processing through different clients' trading data. We are deriving the data from their order management system or mention engine, depends on what the client is using. And then we're running through our engines in order to understand the likelihood of manipulation, as we've previously seen based on known manipulation schemes.
Okay, so it takes what you've seen before, adapts it, and then uses that information
Correct.
For repetitions or variations.
Correct. So we're using a hybrid of supervised and unsupervised algorithms to do that. But the portion we just said is a supervised, yes. So we're classifying it based on things we've seen before, so labeled data sets. Yes.
And so when you say supervised, there's actually some manual part of it?
The manual part would be the data extraction, or the feature extraction as we call it, is to take known data sets of manipulation that is either drawn regulatory attention or been adjudicated, and then to be able to determine what are the attributes that that are patterns of manipulation. Sorry.
Okay. Well, we're going to the weeds fast there.
Yes.
I knew that would happen.
Yeah.
We were talking about the 4 pillars. Let's go back to the 4 pillars.
Correct. So, interestingly enough, we went, and I can tell this, through our story of the origin, right? So, went into early pilot clients and market participants, hearing about the issues of detecting manipulation, investigating it, and reporting it, which is why we've decided to use, as we mentioned, the first 2 pillars, which is going to be crypto-native and ML techniques. But then what we realized is that a lot of the clients were also having issues around usability, around using, legacy systems that don't allow them to collaborate and to investigate a case effectively. So the third pillar really is the idea around providing the client a very intuitive, sleek dashboard through which they can manage the different alerts from the moment of inception until the moment of resolution.
And these are exchanges that are doing that. Your
Correct.
clients are exchanges.
Our right now bread and butter, I would say, are exchanges. Those are exchanges that are not necessarily just in the U.S. where we're conducting the interview, but also globally. We're actually seeing more and more demand coming from Asia as regulators are being a bit more, I would say, up in front about what they need in order to give a license.
More hands-on.
Yes, they at least tell to different market participants, hey, we need to see X, Y, Z in order to grant a license. So that's when we come in with the client, generally speaking, to the regulator and showing them the dashboard and our product and how it's detecting the manipulation, and that's usually how it works on our end.
Let's rewind a bit or step back a bit and look at surveillance as it is today in the traditional market. How does that work? How the crypto ones are traditional?
Yeah. So we haven't, invented the notion of trade surveillance. It's something that exists in traditional markets. It is mandated by regulatory entities for different reasons, and it takes place. I think that, generally speaking, it takes place using different rule-based systems. So you know what you're looking for, right? You know that, yeah.
And the rule-based systems, the rules are set by the regulators or by the exchanges themselves?
No, so when I say rule-based system, I mean that the compliance officers, compliance teams, analysts, they are programming the decision tree based on yes/no conditional rules, right? Okay. So they would look for different things and that they know how they look and smell like. So that's generally speaking how some of the systems that are being used today in traditional markets work to detect this type of market manipulation.
And all of this is to protect investors. So talking about traditional markets to protect the investors, and it's also to obey regulations. Is that
correct? So I think there's a loop here, right? I think that regulators are enforcing the usage of surveillance systems to understand what is the risk exposure and manipulation levels that are taking place with market participants. But I think that exchanges do this not only to make sure their investors are protected, right? Because malicious actors can enter the venue and create a false imagery around a price of a certain asset that can really harm different other, specifically retail investors who don't necessarily understand this is happening. But then the regulators care not because they care to protect investors. That's their job. So regulators care because they need to make sure that the investors are well protected and treated well under some sort of a fair price discovery process.
And the exchanges want this to happen for their reputation and also to keep the regulators.
Yes, I would say absolutely. And if we're talking, I'm not sure if we're talking about, at this point, the traditional markets or the crypto markets, but for the crypto markets, I think it's also paving the way towards additional adoption by other institutional investors, by hopefully onboarding at some point traditional instruments that we know from the traditional markets. So yes, this is
such as the ETF.
Such as the ETF.
But on the saying one last question on the traditional markets, are all traditional securities markets surveilled?
Yes and yes. Yes, the answer is yes, I think to different levels, right? So OTC markets are, for example, don't have as harsh and strict regulations for very specific reasons. But at the end of the day, they do have some reporting obligations that they need to abide by.
You mentioned back in the beginning about crypto markets are perhaps easier to manipulate in some ways. Could you elaborate on that? How are they easier to manipulate than, say, the equities market or the FX market would be? Right.
So I'll talk about maybe one reason in my mind that comes up right now which is also a reason I really like this market for, is the type of market inclusion, right? So there's more accessibility to different retail investors here. But that specifically is a reason why more manipulation can happen. It's easier to create an account on an exchange, thus creating additional accounts and being able to collude between different accounts as it relates to different cross trades. And so the accessibility that is, I think, a great feature of this market and the ability to offer liquidity to previously investors that couldn't really tap into this does create other issues around regulation and manipulation.
So that is something unique to the crypto market that I understand directly. In equities markets, for instance, retail investors do not deal with exchanges.
Right.
And crypto markets they do.
Yeah, I agree. That's a problem we're seeing with our clients as it relates not just to market surveillance, but also to transaction monitoring. The idea of understanding how on an account level different users are interacting, if there's any suspicious activity around transaction in between different accounts, and then how they're trading not just on one venue but across venues. So that relates also to another problem in this industry, which we can touch upon, but the fragmentation of it all.
Okay, let's talk about fragmentation.
Yeah, so that's one of the problems that we're attempting to humbly solve with our client base, right? The idea that if we're helping an exchange in Hong Kong versus Europe versus the US, we're able to alert them in advance for pump and dumps on a certain coin pair, for example, right? The idea that right now there is no one consolidated way to really understand what are different prices across different coins, across different venues. So it's relatively easy for players to manipulate not just on one venue, but doing it coordinately and synced up on different exchanges.
And we don't know who these players are because of the fragmented account nature of the various exchanges.
Yes, correct. We don't know either. I mean, that's, so we're, so the idea that we're abiding by different, GDPR rules, and the idea of we do not hold any identifiable personal information, but we're then letting the exchange know or the venue know of what happened to a certain account ID. Then they can deal with it according to their own in-house protocols. And I think that also differentiates according to the geographical location.
And the rules that their respective regulators impose,
yes,
or the expectations rather than the rules that aren't rules yet.
Right. I mean, so that's really interesting. So the idea is that it's true there aren't, I would say, rules specifically for the crypto market. However, there are existing frameworks today for securities laws and for commodity and whatnot. And what we're always telling the marketplace is that regardless of what regulation is going to look like in the future, something you can do today in order to do your due diligence and protect your investors and make sure you're doing it in good faith in front of regulators is incorporate some portion of market surveillance tools to your stack. And also, just one more point about regulation. At the time when I was at Goldman Sachs, there was a new rule came out, was a tick size pilot program. And in a very established industry, right, this rule is conceptually understandable and people get it. But it took a while in industry discussions until you understand what exactly needs to be done on the system, and then a couple of more years until implemented. So the point is, in a very established industry, a fairly simple rule took a while to deploy. So in this industry, until things are going to be clarified, it's going to take a while, and no regulation is going to come fully formed right away. It's going to be in incremental steps and an iterative approach, if you ask me.
And the fact that this is so different from traditional markets, that doesn't help. You mentioned tick size, and that's something I hadn't thought of, to be honest. And one thing about crypto markets that we don't have in traditional markets is there is no established tick size. You can have trades of a thousandth Satoshi even, or something.
There's other attributes to this market that are relatively different. I mean, the fraction nature of it and whatnot. So there's really different attributes to this market, which I mentioned earlier, that require new tools, right? So to your point, no, you're right on point here. So this market requires new tools in order to detect manipulation, in order to trade, but as well as new rules. And so we can cherry pick from the traditional industry and understand why certain things were established there the way they have, and cherry pick what's good. But also it's an opportunity to really do things in a different approach that makes sense for this industry.
Why else would traditional market surveillance technology perhaps not be ideal for this market? I mean, tick size is the obvious one, and the fragmented nature of the things. Why else might they not be ideal?
I'll give simple examples, right? The simple examples are for, we were in early conversations with the client. So we went into the client meeting talking about fancy schmancy machine learning algorithms to detect manipulation, right? And then they told us that using a legacy system, they had to download the data, massage it, and then upload it back on their legacy system because it wasn't able to deal with the 18 decimal points of Ethereum, right. So it's funny, but it's actually on a database level, adding multiple zeros can be quite difficult across the stack, especially for a system that's relatively established and was built, early 2000s, late 90s. So this is one more issue that is adding considerable amount of work and overhead for clients that are using systems that were built years and years ago.
And you have to update it because otherwise the rounding could end up with material differences in terms of money, which matters.
Yes. Yeah.
Now, what kind of obviously before we go to manipulation, one question also that occurred to me on the fragmented nature of the exchanges, the data. There's no, if I understand correctly, uniform format for the data. How does that make this more difficult?
Yeah, that's a problem across the board, right? And the idea, so the question really to be asked here is what real transparency looks like, right? So some exchanges, they say we provide APIs through which you can see the executions and the bids and the asks of different assets, and we're trying to be good here. So that's to your point, Noel, exactly. Some of them only release it every 60 seconds. Some of them only release it every 30 seconds. Some of them, their updates don't necessarily match with the API calls we're making. So this is really the point to make that we don't know, and there hasn't been an industry standard yet in terms of what it means to be transparent. And this is part of the work also where we're partaking with Global Digital Finance, which is an industry membership organization that brought to the table some of the largest players in this industry in order to understand what are some of the code of conduct around market integrity should look like. So companies like Coinbase and companies like Circle and Consensus and as well as Solidus Labs are sitting there trying to understand what this needs to look like and what real transparency is.
Yeah, that is interesting. How is that evolving? How are the exchanges themselves approaching this need for standardization, and are there discussions going on with regulators around the world?
Yes, so I can tell you, a year and a half ago, when we walked into different conferences speaking about the detection of manipulation in exchanges, not much attention was put on that. Mainly, it was around KYC and AML challenges, which are enormous and important and should be taken care of, and they are by amazing companies out there. And I can tell you gladly that a year and a half now, after that time has passed, everyone are talking about what are we going to do with manipulation, as well as the regulators, right? I think Chairman Jay Clayton said a couple of times that market manipulation and custody are the two issues that needs to be solved before they can entertain an ETF being approved.
Yeah, although I think he didn't actually mention manipulation so much as surveillance.
Correct. Shared surveillance. That's the quote. Yes.
Implied, but
yes.
So what would that look like for him? What would he be? What would the SEC be happy with in those things?
So, regulators, they need to understand what is the risk exposure the market has. And right now, because there aren't too many players that get fully integrated a market surveillance, product to their stack, they can't necessarily understand what is the risk exposure, which then they can report to a regulator, make them comfortable that things are okay. So they need to see more adoption of such tools in order to understand that from the moment of deposit into the venue, all the way through the different account activity to the trading activity, and until withdrawal, that things were, as we say in the company, kosher. Yeah.
And also the confusion, though, that there are no set rules as to what is expected. Just sort this out, sort this out, guys, and let us know when you're ready.
Right.
But in the fragmented nature of the sector, that's going to be hard to get some agreement on.
Yeah, I agree. This is a problem. This is a problem, and that's not a one company job to do. This is an industry push that a lot of us need to come together and educate regulators, educate clients, educate them on what's needed in order to make this ecosystem safer and healthier. So yes, this is a problem that alongside other companies we're working to solve.
And there is progress being made, if I understand correctly. The Bitwise report that came out recently did list a lot of the exchanges that are using surveillance technology. And I imagine there are many more that weren't on the list, people that you were talking to, for instance. But there's no uniform approach yet. Right.
So I agree with you. So generally speaking, as I mentioned a year and a half ago, it wasn't as important in everyone's mind, and today it is, which is great progress.
Yeah.
And I think that the right tools are being provided to different exchanges today, and hopefully soon enough to broker-dealers, and hopefully soon enough to other ATSs and other market participants, right? So yes, things are moving along, but as I mentioned, this is going to take a while.
Yeah, I guess as it should, because it's quite important.
I agree. I think that, the 2017, really, talking about that real quick, it was a crazy hype. And I think that actually, that was a little bit before when we started, and we started in a different approach in that sense. We're relatively, and I think not just us, Solidus, but also other players in the market, we're trying to really create a grounded value, making sure things are conscious and in a healthy way, in a safe way. To really, what are the new pipelines this trading workflow needs in order to make sense?
Yeah, and even just going back to 2017, it really wasn't that long ago.
Right.
It will take time, as you say, but when you think about the accelerated development we've seen so
Right.
far, compared to how traditional markets have evolved.
Yeah.
And the fact that this attention power, I mean, you come from Goldman Sachs, and that's what your team does as well. The
Yeah.
brains and attention power and experience from traditional markets are looking at this problem. That's very encouraging.
Right. I think that the fact that there's other, players that enter this market from the traditional finance and are able to draw inspiration from that as it relates to compliance and trading workflows is highly important. I couldn't agree more with you, and I think that, in a way, this market decline gave us a very necessary breathing space in order to understand what are the right steps right now to take in order to get it to the next big adoption or next wave of institutional, possibly, involvement here.
Yeah, and as we've seen at the events that we organized, the level of institutional interest did not stop growing even during the bear market, and there's a lot of building going on. And so this time round, would it be different?
Hey, who knows?
Manipulation. Let's talk about that. What kinds of manipulation are the most common that we've seen?
Yeah. So we're helping our clients with different wash trades, spoofing, pump and dumps. So those are definitely very much up there. We're also helping them, as I mentioned earlier, with the different, more nuanced manipulation techniques. What I think we can all agree on is that this is a new space that, with its enormous opportunity, also presents new opportunity to manipulate. And so malicious sectors are becoming more sophisticated, are becoming and are using the different vulnerabilities in different exchanges to create new ways to manipulate. And so this all needs to be tied in back together into the new ways to detect them as well. So not using rule-based, but rather probability scoring and ML approach.
And there's probably not even a clear definition of what manipulation even means. And maybe your definition of manipulation is my definition of being smart about the market.
You know what? Yeah, that's a great point. I think that, but that's something that I think a business owner, like an exchange, can't expect all of its clients to be smart about it. They have some responsibility to make sure that whoever signs up to his exchange is exposed to the least amount of possible risks they can be, that is manipulative in nature, right? So of course, if you're going to an exchange and making a bad investment, that's on you. But if you're making a bad investment based on false imagery of different prices, that's a different problem.
Is it easier to manipulate in a liquid market or an illiquid market?
Right. So, if we can talk about liquid markets, let's say from the traditional point of view, and that, unfortunately, this is still a problem, right? Manipulation is still a problem. And I don't think anyone expects, 100% manipulation-free environment. But what we're expecting is 100% transparency environment where you can hold users accountable for what they're doing. And so, generally speaking, even in liquid environments, yes, there's still manipulation. In illiquid, you can employ certain types of manipulation to make them, to do different manipulative schemes. So I think they happen in both, unfortunately. It's not that the problem has solved on liquid versus illiquid.
That's curious. Interesting. I would have expected that with an illiquid market, it's easier to spot because there aren't that many trades, but with a liquid market, there's more firepower behind it.
True. So, in 2017, when there were a lot of, more retail investors that didn't really know to understand that if you're investing into an altcoin that barely has any value and all of a sudden it's going to rise, that's a classic pump and dump. So, yes, I agree with you that in liquid assets it can happen more in that sense, but I do think that investors generally became more savvy, and I hope know to look out for those things. And so manipulation happens in both markets, unfortunately still.
We talked about the types of manipulation, and pump and dump you just mentioned, that's probably the most obvious one, right?
Yeah.
Where you ramp up a price just to sell and then bring it down again. How does that work?
Yeah, exactly as you mentioned, generally speaking, and we've seen it in different ways and in different markets. a group of people usually would collude in order to get an asset price upwards or downwards, depends on how they're doing the manipulation, and thus gaining more traction from unknowingly and innocent other investors to put their money into the same asset. And once it goes to a certain point, they all dump it, right? Yeah. So, and then they're making money off of that offset spread.
And that's easier to do in an illiquid market.
Absolutely.
And what about spoofing? That's another kind of manipulation we hear about. What's that?
Yeah. So it can come in different flavors, but really the high-level explanation would be is when traders send orders that they never meant to execute to begin with, right?
And why would they do that?
In order to create to switch the price or to change the price for their own benefit when they're trading.
So they would flood the market with orders at a certain price. The market would think that was the price, and
yes,
therefore execute on that?
Absolutely. So they would basically fill in the order book with a lot of different, and we're talking here thousands, right? We're not talking a few of them. We're talking about thousands of orders that are all of a sudden canceled at a certain point, and at that point you can see them either switching their bids for asks and vice versa. So the idea is that they're flooding the market with orders that were never meant to execute. Mm-hmm. And by the way, in traditional markets, interestingly enough, even if you detect it, sometimes you almost need to really have a strong case to justify the fact that he never meant to execute these orders, right? So that's really interesting.
It's like a he said, she said kind of thing?
Sometimes it's very obvious, but sometimes you need to build a case. So you need to see a pattern. You wouldn't necessarily say on the first go, this is spoofing, but you would see that account activity across time and see whether or not this behavior is a one-off or is it been happening for a while now.
And once you've done that and you identify that this player has been known to be, but that involves KYC as well, because on crypto exchanges they could change wallet addresses or IPs or something like that.
Right, and so KYC is an incredibly important point for this industry to understand where the funds have been deposited from. But oftentimes I can say that funds are deposited in a way that is legitimate, but then the trade activity in itself isn't. So I agree with you, by the way, that there needs to be a holistic approach for something I call, the fraud journey here. As I mentioned earlier, it's not just about the trading activity. The point is to connect it to other compliance streams across the stack and understand an overarching risk score for that account, which is what, we set out to do. So the idea is, and maybe I'll mention something quick here, is, market surveillance is incredibly important, but as I mentioned earlier, transaction monitoring and onboarding for the client, and then integrating that into KYC and AML data streams to get a holistic image around one user to understand their activity, not just around trading, but also around their activity, where they came from, who they are, what they're doing. So that really gives them a more accurate approach into risk assessment.
And therefore, it will also make it harder for that particular user to then take his activities to another exchange once one exchange blocks him or her.
Correct. And so that's also something, blocking the trades or the user. This is something that we generally leave for, the venues to do. So we are, in a way, I see this, we're like a data company at the end of the day. We tell our clients what is the likelihood of manipulation, but then they need to decide what are the steps they're taking. Like, we don't bust orders or anything quite like that. Then they can decide what to do. And by the way, maybe we mentioned this earlier. I should have mentioned this when we were talking about specific challenges of this space. Mm-hmm. But one of the challenges we've heard from our clients is the fact that they need real-time monitoring, right? Oh. It's relatively easy to go into an exchange, do whatever you need to do, and then kind of immediately leave it. Mm-hmm. And so if they don't have a tool that is able to provide them alerting in real time, that's a real problem. So that also has to do with just newer technologies to use in order to be able to provide to them the almost pseudo or near real-time alerting.
What would happen once an exchange that uses your technology gets an alert? What would they do?
Yeah, so that depends on the in-house protocol of that exchange. Generally speaking, they have different investigation tools to understand what happened exactly in that moment of time that caused the alert. We also provide some explanations as why this came up. And then they can generally speaking, they would investigate further, they would escalate it appropriately.
They would do that, or they'd ask you to do that?
No, so that's the client has, dedicated compliance teams, which, by the way, again, it's all connecting to previously points we've mentioned here. The fact that companies right now have dedicated surveillance and compliance teams is huge for the industry, right? It didn't happen, a year ago. It wasn't a thing. And today, we're working with our compliance teams and different analysts that their whole job, they're dedicated to understand what's happening underneath the hood.
It must be so exciting for people that have spent their life in the compliance sector.
Yes.
An entirely new type of asset and a new technology
I
to get their heads around.
couldn't agree more. I know I briefly mentioned to you earlier when we were speaking before we started the session is that a week ago we spoke to a Wall Street veteran who used to work for a regulatory agency, and we told him how, we're joking around and told him that we're trying to make compliance great again. And then he told us, how about making compliance great in the first place? So yes, so that's what I think compliance folks are excited about the prospects here.
That's brilliant. Now, we understand that this is exchange-based monitoring that you're doing, but is it different to surveil Bitcoin trading as it is to surveil Ethereum trading, for instance, or Tezos or something like that?
Right. So to us, or to it's not as much of an issue. We are working. Most of the exchanges in this space are centralized, right? So in that sense, we don't really mind from a data perspective and from a surveillance perspective. What is the asset's nature, whether if it's Ethereum or Bitcoin or something else. I think it matters most for decentralized exchanges, which we are speaking with a few of them. I think that, generally speaking, from an industry point of view, it's going to take a while before they're more fully operational. If you ask for my opinion, I think it's going to be a while before they have volumes that are justifying institutional adoption. And so we're talking in the trust, and so it's considerably down the road, and they have, as we just mentioned, new ways that they need to worry about when it comes to manipulation.
Yeah, and especially when you flag some potential manipulation on a decentralized exchange, there isn't really anyone that can then investigate further.
Yes, correct. That depends, I guess, on their governance structure, and they should probably.
Oh, that's true. Now, we talked a bit before about the automation of surveillance, and it is increasingly becoming totally automated, or do the compliance teams still have a big role to play in this function? Yeah,
that's a good question. So we try to automate the process as much as we can before the client gets an alert, right? Not only that, we're using different techniques to learn what the client is doing on the dashboard. So for example, if a client is marking certain alerts as false positives repeatedly, we would learn from that and enhance our models to understand, okay, this is something that, in spite of our models, we're seeing the client's feedback here, and so we're incorporating that into the overarching model. So that adds to the automation point of view, and we're trying to automate truly everything, not just from the point of the detection of the alert, but also through the investigation of it, providing whatever is needed, but also, and that's important, the reporting of it. So regulatory reporting is a huge undertaking in different companies, and so we're already surveilling the client's data. We're already detecting the alerts, and so we might as well persist it for 7 years and allow them to make their different regulatory reporting obligations off it. So yes, so the reporting is also something we're automating for the client. At the end of the day, though, as it relates to the actual determination of whether or not this is an alert, this is on human experts to look at the alert, to look at what the machine spit it out, and determine whether this is an issue or non-issue.
And the reporting function must be difficult when there are no set standards, yes?
Yes. So, there are no set standards. But hey, we're seeing clients asking us about MiFID. They're asking us about OAT. They're asking us about, of course, specific activity reports. They're asking us about different region-specific, reporting obligations as they are trying to become the most compliant or regulatory-oriented companies out there. So it's surprising for me as well. Some clients are truly forward thinkers in that sense that they want to have, just in case, the regulation in place for reporting.
Moving on to the SEC and EPS, as we mentioned before, they have cited the lack of surveillance sharing agreements. What impact would it have should standards be set, in your opinion? Should we derive some sort of agreement amongst all of the major exchanges that these are the surveillance standards that we're happy to go with, and we're all talking to each other and working together? Would that change the approach that the regulators are taking so far, do you think?
I would say so. I think that, as I mentioned earlier, this is going to be, so it's funny, right? Exchanges can come together and determine that are the standards they need to act by in order to create a more a fair and safer and transparent environment. That can also be just for that time being, right? So things are going to change and evolve over time. And so what's true today for exchanges agreements cannot necessarily be true for the next day. And so, but yes, to your question, I think that it's highly important. I think that regulators do care and pay attention to the different organizations and entities in this space trying to move forward and trying to make rules and standards that we would abide by. We're speaking to regulators routinely from different regions in the world. Their knowledge, sometimes people treat, regulators as if they don't necessarily know what's happening. I have to say, I'm time and again amazed by the level of knowledge they display when I'm talking to them, to things around, blockchain that I don't even necessarily understand as well. and so they're highly paying attention. They're paying attention to what's happening, and they, I think, appreciate the fact that innovators are trying to work together in order to bring standards.
Are they inputting requests? Are they helping to shape this technology?
So we meet with them routinely. Part of it is to also show case what we're doing, what is our product, how do we detect manipulation, how do we assess risk, and we often take their feedback and take that into the design of the product, right? They offer their feedback. They mainly it's a high level discussions, generally speaking, about what are their concerns, what needs to happen for them to feel more comfortable. At the end of the day, the one sole KPI of a regulator is to make sure that investors are protected. And so that's really what is guiding us as we're building the product.
It's curious, given that the regulators themselves aren't undertaking the surveillance.
Yeah, I mean, look, this is a problem. Not necessarily a problem. I think that's okay. I think that undertaking surveillance is a large undertaking that demands certain skills, very specialized skills. And I can tell we're hiring, and it's very tough to hire when you're looking for people who understand finance, trading, affinity towards digital assets, and whatnot, manipulation. So you really need a specific set of skills in order to bring about an effective and an efficient market surveillance product. To do that, you really need to have special companies that will rise to do that. So I think that, today you can see, obviously, FINRA is the authority that is highly technical and always making sure that the companies underneath them and our members in the organization are doing what they need to do to be compliant. But at the end of the day, as we kind of said earlier, it's the responsibility of the business owner, right, to make sure things are working there well. And it's the responsibility of the regulator to make sure it does. And they're doing it by different ways.
And trusting the businesses themselves to come up with increasingly innovative ways in which to do this, which is effective.
Correct. I think that, what we're entertaining is also to possibly, produce a version of Solidus for regulators so they can then see what is the market's overall exposure for risk as it relates to different companies. And again, this is all to take a step forward here to make sure the next evolution of this market comes about.
Are the rules different, or the guidelines, or the standards, if you like, different for surveillance in different parts of the world, say Europe versus the U.S., and how does Asia approach this? Is it different?
Generally speaking, it's the same with some nuances for reporting and the way things are formatted, I would say. But generally speaking, they're fairly similar. And as you see also in the traditional finance, there is, in a way, I would say, a consolidation of rules across regions. At the end of the day, you can do, and trading happens offshore all the time, so rules somewhat are intertwined. And so what we're seeing is it's relatively similar with some nuances as it relates also to reporting.
So let's say that a couple of years from now, given the pace that we're doing it so far, surveillance is standard on the major exchanges around the world, and people understand it, and the regulators are happy with what's going on.
Yeah.
What impact will that have on the Bitcoin market, for instance, itself? How will that change how trading is carried out, or how will that change who is involved?
So, that also brings an interesting anecdote I've recently had when someone was telling me, why would exchanges need this, right? They're making a fee off of each transaction, and they don't mind having ghost volume. Well, here's the problem. It's illegal, as we covered earlier, but the idea of having trade surveillance in a robust and safe environment to trade means that institutional investors might come in. And that's really going to offset any loss that exchange might have from that, ghost volume going away. So we're talking about, new instruments that can be traded on these venues under a regulated and somewhat safe approach, right? So it can really shift the different even business models exchanges are enacting. It can enhance their bottom line tremendously by this new business coming in.
How can it shift business models?
It can shift in the sense that new type of assets can be onboarded, right? So
and a new type of clients maybe as well.
Exactly, new type of clients, right? The idea is that everyone almost are in. You mentioned this to me, by the way, when we spoke over the phone. Everyone are in the race towards the starting line here, right? And the idea is that we're trying to understand how that starting line should look like for these additional players, additional assets to come in. And I wish there were cameras on us because I'm using my hand motion to kind of show you what I mean here. But yes, this is
a starting line with his and he's moving towards where the other hand.
And so it's really exciting. A lot of moving pieces here. But yes, this is truly the folks are thinking much longer approach here of how things can look like, considering their venues and be safe to trade on.
Yeah, and for us watching from the sidelines, it's so exciting. Not only the legitimacy and the cleanliness, for lack of a better word, of the trading that technologies like yours can offer, but also the data that you're collecting that will help us understand more deeply who's doing what and why. And I'm talking about not just the manipulation side, also the legitimate trading side.
Yes, I agree. I think that, when it comes to manipulation and compliance and trading and finance, I think that digital assets offer us themselves as a fuel to drive transformation across the board here as it relates to finance and trading, and yes, compliance. So now we have an opportunity to rebuild, or I wouldn't say rebuild, to build a new asset class that is driven by innovation. It's truly, that's what excites, I think, a lot of us in this space.
Greater compliance, greater trust, greater legitimacy, and therefore also greater attention and investment in the use cases of technology.
Absolutely.
I could go on talking to you for ages about this, but let's move on to some of the questions that the listeners have sent in. And again, thank you very much for that. I'm going to hand you the list, and you can choose any question you want from that list to answer.
Let's see. Should I read the question? Yes.
Yes, read the question, please.
Okay, what are the technical challenges to crypto exchange and security in 2019 and 2020? So we touched that question, I would say. Some of the challenges are, technically speaking, is building, a surveillance program, right? So we always go to clients, and I think that the question of build versus buy comes up. And, what I say to our clients is that they need to focus on their core business. If they're an exchange, mention buyers and sellers, which takes a whole huge operational burden on its own. So generally speaking, I think that this is a technical challenge to build a comprehensive risk assessment tools such as market manipulation detection and transaction monitoring and onboarding and whatnot. So that's definitely a challenge I'm seeing here. And also,
jumping with one myself, is it different for each exchange? Do you have to adapt your technology for this exchange, or is it just you just help them plug in and they're ready to go?
That's a great question. So we don't think that one size fits all. We work with our clients to adapt the system to their own needs. I didn't mention earlier, by the way, our fourth pillar, but our fourth pillar is customizability.
Okay.
For the clients to be able to customize the system as they need, which also relates to automation, right? They don't need to call us if they need to, for whatever reason, expand the different parameters around the algos. So, for example, if they think that they need to expand the time spent between buys and sells to detect front running or spoofing or whatever it is, they can do it using different sensitivity adjusters on the dashboard itself. So we offer customizability for the client for their own specific use cases, because each client is trying to build their own amazing system and not one size fits all.
And again, standards across the system, therefore
Correct.
It does make variety.
Correct. And yes, so this customizability approach is highly important here. So customizability, coupling it with a user-focused and team-focused approach, as well as crypto-native and ML, is really how we're keeping in mind these pillars as we're building the system.
Perfect. Excellent.
Next question. Let's see. Let's go down the list here. How much of a barrier to entry would increased surveillance compliance cause? There's been significant pushback from governments. Okay, so we think that surveillance, so we're seeing it today, some of our clients, so the question was, and how much of a barrier to entry would increased surveillance compliance cause, right? So some of our clients, they are not even launched yet, right? They are working first to get a license and then start trading. So we're seeing more and more of those clients that are former bankers, former, fintech folks that understand the fact that they need the system, right? When that's actually some of the best sales pitches I've had ever. When we go into a client meeting, they're all former bankers, and we tell them, okay, so we're doing surveillance specifically for crypto using ML, and they, okay, done, we need it. We need it in order to launch. That's the license right here. Let's go. So yes, this is a barrier that clients need to make sure they have in their stack before they're even launching. Some of them, right? Of course, there's plenty of players out there today that are already operating, of course, and they're using some solution either in-house or associated with companies.
Actually, I think there's one question you have on the list there, which I thought particularly intriguing. It ties into what you just said. Could this technology be used in other industries?
Yes, yeah. So interesting question, and we're toying around with that, in our mind all the time. So I would say, first of all, for a company, a large bank, compliance and trading is only one stream of risk they need to assess, right? So a compliance officer would then report the risk exposure they have to the chief risk officer of the company. But across the board, they have technology risk, they have information risk, they have a lot of other risk exposure streams. And so, I'm giving here a little bit of a view into the future, but the point is that this type of manipulation detection using ML models could be translated and almost not copy-paste, but to other risk assessment needs the company has. So yes, it could be used across other, not necessarily industries, but across other company needs. Yeah.
What about fraud detection?
So fraud is a large word that has a lot of different, it's an umbrella term almost for so many different things. I would say that it does help in account takeovers, yes. It helps, that's on a transaction monitoring level to understand whether all of a sudden a certain account is acting differently than it has been before, or even in relation to other peers and other accounts that are similar to that one. So yes, it does help with fraud detection and account takeovers, absolutely.
And that could also perhaps spill over to other industries. I'm thinking data reliability or healthcare even.
Yes, yes, absolutely. Future, I think, we just came back, we met in Money 2020, and, I think that a lot of companies are looking into AI and ML and understand how that can influence their business. I think that, what we're doing is educating also regulators around ML and how that really can help drive innovation forward in our own little world of compliance and trading, but it's true across other industries as well.
And especially in a world in which we depend increasingly on data. Services like yours that validate that this data complies with certain standards and is above board is increasingly important, and not just in the crypto sector.
I agree.
I could go on. Next question.
Yeah, next question. Let's see. Okay, so this one is about AML. So what do you think the means of observation and scrutiny will be in the name of anti-money laundering? Okay, so
relevant as well these days.
Relevant, very relevant.
Is the G20 meeting happening, I think, today or this week?
I agree. I think so as well. And yeah, they had the observation when needs to happen. I think that regardless of my opinion, I think that AML and KYC of the determination of the financial action task force, I think that AML and KYC are highly important in this space, and there's great companies doing great work. We're in touch with all of them as we're trying to also understand what is the right flow here to ensure a better market. So yes, AML is absolutely important to figure out in a way that, by the way, is unique for this market. So I think that's also some of the pushback we've seen. Rules from the traditional space does not necessarily apply the same way they are to this space.
Why?
For different reasons, right? So we're seeing on transaction monitoring level, which is our space, the fact that Reg 504 doesn't necessarily...
What's Reg 504?
So that's different regulation as it relates to transaction monitoring, inactive account to an active account, or all type of round amount transactioning. And so they have different rules that are important to watch for. But as we mentioned earlier, because there is an ability to create more and more accounts, there is more ways on a transaction or an account level to manipulate. And so we need to look for those new ways in addition to those previous mandated ways, which are possibly not necessarily as relevant anymore. And so that's, I mentioned earlier, we need to cherry pick from the traditional industry, understand what are those new rules now that coupled with the cherry picked one can make sense for the industry. And I think that the companies that have been pushing back are great companies that are truly working through some of their very challenging problems, and they're only mean well, right, to bring about a better way to regulate this market.
And could the fact that this is more challenging than traditional markets, and perhaps more data intensive,
Mm-hmm.
because we're talking about blockchain-based data, could that end up influencing the way the traditional security sector handles this?
That's an interesting question, whether or not that's going to spill back into the traditional market.
Circular approach.
So I can tell you this. I can tell you that we've been approached by traditional companies asking whether or not what we're doing in terms of manipulation detection can be translated to, futures, equity, and whatnot in traditional markets. And so in that sense, we've received some feedback, right, saying, they're using rule-based systems and they want to start playing around with the amount of data they have to understand new ways to manipulate. And so, no, we're not right now doing that, but that, I think, is something interesting that's been happening. The fact that this industry allows for more innovation and more creativity, perhaps, would spill back into the traditional market.
I'm curious.
Yeah.
What do you say to them when they ask you?
I tell them to, once we are finished with our next, financing round, we'll touch base with them. Another question. Let's see, there's only, should I go for, okay, are there any off-the-shelf solutions for crypto exchanges to use for market surveillance? So yes, off-the-shelf solutions, there are other companies in this space trying to do great work, sometimes also taking their existing product from legacy systems and translate them to this newer space. So there's different solutions out there for different companies to use. And I think it really depends on what are your goals and what are your KPIs for your company and what you're looking for and when you prioritize a certain system. But yes, there's off-the-shelf solutions for crypto exchanges to use today, for smaller businesses, for mid-sized companies, and for large companies.
And I imagine the off-the-shelf ones, and even traditional surveillance technologies, they are always updating and iterating, but building something from scratch perhaps gives you more creative leeway to get artificial intelligence or machine learning involved.
I think that you're on the money here. I think that having worked in a large corporation, building something from the ground up is generally very challenging and different, and it's sluggish and it takes time. That's where startups really flourish, right?
As any innovation team can tell you.
Yes, absolutely. And so, so we're able to do things that large corporation wouldn't necessarily be able to. And, you mentioned earlier updating the software and whatnot. I think that's also something that SaaS enterprise software solutions like ours can do possibly better because it's a SaaS solution, right? Yeah. It's not necessarily on-prem like legacy systems that it takes a whole thing to now update. Yep.
And they have the clients. Those questions updating the stuff that the clients already have.
Yeah.
Okay.
I think we're done with this portion. Is the SEC more concerned about market manipulation or front-running trades? It's not one or the other, right? It's not. They're concerned about everything. They're concerned.
They don't see one as more damaging than the other.
And also, front running is a form of manipulation. So, it's a subset within market manipulation. They're concerned about the overarching risk as it relates to different ways to manipulate. I can say that in our discussions with them, they brought up one concern over the other. I think it's an industry level macro approach to. We have zero visibility right now. That's the problem, right? And it's a daylight problem. It's the fact that there is no real transparency. And we always say this across Solidus offices is that the daylight is the best disinfectant, and we need to shed more of it across the different venues.
Absolutely. And but the lack of transparency in the exchange trading sector of the crypto market is incongruous given that the blockchain technology is about transparency, is about all the information available to everyone. And yet the actual trading that's going on top of it isn't.
Right. It's an interesting point you're making here. It's correct. The idea is that everything is transparent on a blockchain level, but then when an exchange, which is a centralized venue, is creating is creating a marketplace for buying and selling, the transparency isn't necessarily built in for investors. So correct. It's an interesting distinguishing here.
And the difference between front running and spoofing, for instance, could perhaps also be who is doing it. In front running, it's the exchange themselves that are guilty often. And
Yeah.
in spoofing it is external actors. And does that influence the way the regulators think about this?
They are. I think as it relates also to different market participants. I know that for front-running broker-dealers and would need to make sure that they have traders that are abiding by different rules and they're not front-running clients' orders that are coming in. And for exchanges, they're more concerned about right now about their level of volumes that is questionably not accurate. So I think exchanges are really focused on reducing the amount of spoofing and wash trading, while broker-dealers or entities are trying to get BD licenses and ATS licenses need to make sure that there's no front-running happening.
And the exchanges are obviously investing in this because sunlight being the best disinfectant, etc. Is this something that they use in their marketing?
Yeah. I think that different exchanges do market the fact that they are using different regulatory, ways to detect manipulation, and they're using it in their marketing. But that's what we've raised earlier. What does it really mean? If you just hired a compliance officer, does that mean that that's it? You're covered, and you have someone that is making sure all is legitimate? If you're releasing the data every few seconds, does that mean that you're being transparent? What does it really mean, right? And that's what we're trying to tackle here also as advocates here. Our job is not just to build a product, but it's also to advocate for what is the right standard as we're moving forward with the whole industry. We're really on the front lines here, ourselves trying to figure out alongside some other great companies what is the standard. So yes, I think different companies are using this in their marketing efforts. I haven't seen companies are using this, out of proportion. I think that these companies are fairly grounded and trying to do things well, and so we've seen it around. Yeah.
You're working with Global Digital Finance, you mentioned earlier, on developing standards for this. What
Right.
kind of level of agreement are you seeing so far amongst the different exchanges?
Yeah, so I mean, first of all, the fact that there's a very impressive founding team of companies who joined GDF in order to understand what are the standards, right? That's on its own is a great effort by the industry. We're leading the Code of Conduct for Market Integrity Thinking Group. And yes, I can happily say that exchanges have signed up and want to contribute as we are circulating around our thoughts towards creating a standard for this industry. So I'm happy to say that things are moving forward. I think that it's more about understanding what is the end goal here. And as we mentioned, the end goal is new type of clients, new type of assets in a very innovative space. And so everyone can see that, I think.
That's very exciting. It's not every day you get to see sector built from the ground up, as well as the actual structure coming down to make it clean and regulated and accessible to all.
Yeah, it's very exciting. I think that, as you mentioned, most of our team is from Goldman Sachs, people who have been in traditional finance and saw this as an opportunity to truly innovate. I think sometimes it's harder to do from large corporations whose business model are very determined and the tech is very well harnessed, and you're almost afraid to change anything because, oh my God, it's channeling so much funds through it, right? So everything has such a risk associated with it. So this new emerging space really allows for more, I would say dry bankers to come in here and really innovate and be creative. Yes, it's very exciting.
Where do you think market surveillance will be as a sector 12 months from now? What will you and I be talking about 12 months from now? What will be your biggest problem?
Surveilling, traditional instruments as they've been onboarded through different venues. I think that
the different instruments, including, for instance, security tokens and other things that we're not really looking at yet.
Right, absolutely. I think that different companies are looking to innovate in that space, in issuance, and what can be liquidated across exchanges. And there's so many interesting things that are happening in the space, and we don't even know yet how they are going to get traded, what is the right workflow here, what are the type of manipulation and typologies they will introduce, right? So as you told me, Noel, we're at the race towards the starting line.
Yeah, and it's certainly going to keep you on your toes.
Oh, yes. Every day is very interesting in Solidus.
Yeah. Anyway, I could continue talking to you for ages, but we're running out of time. I want to thank you so much, Asaf, for being here today and sharing your experience and your vision and your ideas of where the sector could end up going. It's certainly going to be interesting to watch. And thank you very much, listeners, for joining us also. Again, this will be uploaded onto our website as soon as we can if you want to listen to it again. And do please tell your colleagues if they didn't have time to tune in. It certainly is was for me anyway, very educational session on the data and on the way that the sector is working together. We've seen this in other areas, but here's a first example of how the sector together is trying to make this real and clean and reputable.
Thank you, I had a pleasure.
It was fun. Thank you very much, everyone. Talk to you next time.